Our next speaker, Carlton, has had 30 years of financial services experience. He's been a management consultant at BCG, CEO of Confused.com, Chief Customer Officer at Old Mutual Quilter, and started at Guardian in May of this year. He's had experience in pensions, lending and protection, and describes himself as financial services jack of all trades and master of none. Please welcome to the stage Carlton Hood.
Thank you, and I think it's just ticked over, so good afternoon. Maybe a couple of words of introduction. First, for Guardian, for those of you who don't know it, if there are any, we are a relatively new kid on the block, so less than 10 years old as a UK pure protection provider, but with a very old brand, so over 200 years. So think a little bit of a primary school child dressed in his granddad's suit. That's kind of us. And I am relatively new as well, so not quite 6 months into the job. And I thought it'd be really funny, therefore, to put this title up and put shiny and new. And I showed it to our commercial officer, Hilary Banks, who just said, well, you might just about get away with the new, but you're not going to get away with the shiny. It's brutal in the Guardian management team. So maybe we'll just think about it as me as sort of fresh meat. And to prove that I'm not shiny and new, let me go back to treating customers fairly. Who was working in the industry in 2001? Show of hands. Oh, a few people. So 2001 was when that came out. Principle 6, a firm must pay due regard to the interest of its customers and treat them fairly. Missing the word all, we note. But regulation has moved on. 2016, fair treatment of long-standing customers in life insurance, where the FCA concluded that we should ensure that closed-book customers are treated fairly and do not receive less attention than customers who have recently taken out a new product. Fast forward 2023, Consumer Duty, which we all know and love. A firm must now act to deliver good outcomes for retail customers, brackets, in the future, and we must avoid causing foreseeable harm. So I think from a regulatory perspective, that TCF gave us the philosophy of treating all customers fairly, and Consumer Duty is giving us the requirement to act. Now, there are some salutary tales out there, and I have to say that in this period, somebody at the FCA, they were employing some great creative people because they came up with some wonderful names. So first of all, 2021, price walking. I mean, we've had, I'm not going to do the moonwalk on stage, and I'm not going to try and emulate what price walking must be, but I am going to talk about the fact that in 2020, the FCA found that 6 million policyholders were paying more than they needed to for their general insurance, simply because of tenure. Now, at the time, I had just come out of Confused.com, where actually we made a living out of serving those customers. People who were pissed off because they'd got a renewal that had gone up by 20%, nobody could tell them why, and when they went onto our platform, they would either find that the quote from their existing insurer was lower, or they would find, which happened a lot, that there was no quote available from that insurer on the platform. The FCA did not think this was very cool. There was a 14-point plan. They asked that when a firm offers a renewal price, it must ensure that it's no greater than the equivalent new business price through the same sales channel. And now that remedy is saving consumers about £4.2 billion over 10 years. It has not, however, ensured that industry from the super complaint from Which about the quality of the cover that they receive. Moving on, Flytrap gets better. The Telegraph described this, which is about deposit accounts in banking, as a loyalty penalty baked into the system. The FCA said that firms must ensure fair value for all customers, not just those opening new accounts. Banks have since been forced to return £4 billion to savers to increase that pass-through rate of just 28%. So only 28%, just over a quarter of customers, were getting the benefit of an increase in deposit accounts. I don't have the number in front of me for how many of them saw their rates go down when interest rate fell, but I bet it's higher. Now you might be saying, but that's not us, we're different. That's about pricing, it's about annually renewable policies, about rates that move with markets. I would say, is it? In the heart of it, there is a simple principle. It's the same product, it's the same provider, but it's a worse outcome simply because some customers have been there longer. So, 2026. Now, this is obviously a little bit of poetic license, and yes, I am bidding for that job in the FCA that comes up with the trendy little phrases. I don't think I've done very well. Maybe you can come up with a better one. So is 2026 to be the year of cover lagging? Well, our customers think it should be. We did a survey that found out that 2/3 of our customers say that if a provider improves its critical illness definitions, they expect it would be available for existing and new customers. Our customers are already there. They think this should happen. A high portion of them think that it is happening, but of course, it's not. Now, this is where I'm going to get into trouble on those self-promotion guidelines that we had earlier. I looked around the market and I thought, right, I'll put together a list of all of those companies that are offering a kind of service where where old customers get exactly the same terms as new customers, and that's promised all over the place. I'll tell you, it was really hard to find one. But I did. I'm just going to call it Company X. This company says, if we improve our critical illness definitions, every customer can benefit, not just the new ones. It was launched in 2018. We've had upgrades in 2019 and upgrades again in 2025. So this is a product that is in the market. And we are trying to overcome the fear of being first. Now, luckily, I was able to get a real solid amount of time with this company, and I was able to talk to them about the challenges of putting this out there, right? And it isn't easy, so I'm going to give you a little bit of the warts and all approach, building a little bit on our previous speaker. So first of all, the reinsurers. Yes, they're not queuing up to do this. It is the new and unknown, and you are asking them to provide cover for a benefit looking forwards, but then also looking backwards. And they don't know what that future brings. Then costs. It makes premiums more expensive. We are in a super competitive market. The cost to administer is greater, right? And you have to, I think, and this is one of the criticisms that we do sometimes get, you have to put in the proviso that you might need to make that cover upgrade a paid option in the future. We will do all we can not to make that true. But you don't want new customers to be subsidizing old. That also is not treating customers fairly. Now, then there's systems. You've now got multiple versions of the same products. You've got T&Cs that don't change and cover options that do. You've got downgrades potentially, and you don't downgrade, right? So now you've got further variation. This gets more and more complex as you go on. We have industry comparison tools. They don't know what to do with this. Right? How do you quantify the benefit and put it into a coding? It's not easy. You can't get the credit. And then you have to build special tools for customers so that they can overcome the complexity, even though it's in their best interests. But it does make a difference. This is John. John actually is a financial advisor. John took cover in 2019, right? There was an upgrade in 2019 as well about Parkinson's disease. And in 2023, John contracted Parkinson's disease with an associated tremor. However, he wasn't yet experiencing muscle rigidity. John's claim wouldn't have met the original definitions policy. We paid under the improved definition. That made a real difference to John. For those of you who are the policy geeks in the room, right, and I will read it quickly. The first definition, a definitive diagnosis by a UK consultant urologist of idiopathic Parkinson's disease. There must be permanent clinical impairment of motor function with associated tremor and rigidity of movement. Got that? The revised definition, a definitive diagnosis by a UK consultant urologist. There must be permanent clinical impairment of motor functions. This impairment should include either an associated tremor or muscle rigidity. The difference is and or. But that difference made a real difference to John. He said, as an advisor, when Guardian came to market with its critical illness policy and its cover upgrade promise, I could see it was special, and that was part of the reason I took out this cover for myself. advertorial over. So, here's the challenge for us all, and the challenge that Jason outlined so eloquently as well. It's easy to say, as these two fine gentlemen are, that's a nice idea, it'll never take off. It's easy to say, it's hard to do. It's easy to say, it can't be afforded, right? But sometimes you have to give it a go. Can we do it better? Can we make it formally a paid option? Can we get value for it in our comparison services? I don't know. I'm sure we can. What I do know is that it is actually delivering better outcomes for an increasingly growing number of customers. And what I do know as well, and I think this is the theme of a previous conference, that whilst it may not be perfect, I do think it's good. And I think it's incumbent upon us all to keep trying. Thank you very much.